Nyaga, who is an analyst joining us from Empire FX. Cyprus, welcome to the show and thank you so much for making the time to speak to us. Just your view on investor sentiment right now and what you think is likely to move the markets in the day session.
So thank you so much for having me here. So this week, basically we've seen a lot of volatility in the markets globally. We saw today South Korea open up around 7% up. In Hong Kong was up as well. And the reason is yesterday's inflation numbers came out softer than expected. The headline figure came out at around 3.5, and the core went down a bit to 2.5. Markets were expecting it to come in at around 2.8%. Remember, a day earlier, we had Christopher Wheeler, who is really one of the biggest doves in the Fed, come out saying that the Fed should hike interest rates if the core CPI remains elevated. But now it came out a bit lower. So I think market participants are pricing in a situation where the Fed does not hike interest rates probably this month. But basically we think that the Fed will ultimately hike rates probably at least once this year, because even though inflation fell in June, it remains above the target of 2.0%. It has remained above that for over 5 years. And remember also that Kevin Walsh is really a hawk since for a long time. And so we really expect, and even yesterday in his testimony to Congress, he maintained that he's focused on inflation. So I think also that the fact that the war has returned and we see crude oil going up, it will push inflation a bit up, significantly higher probably this month. It came out, so probably it will go back to, let's say, 3.8, 3.9. And so we should expect the Fed to probably hike this later this year.
Yeah.
And the same thing.
I'm just going to come in there, Crispus. Sorry, I'm just going to come in there. You mentioned that the inflation print coming from the US, it did come in softer than expected, notwithstanding that it does remain elevated at absolute levels, which would still push the Fed to hike, even though it might not be as early as July as many market participants had expected. Still on the Fed's monetary policy path, which is complicated, when do you forecast, or when do you think that first interest rate hike would come? Are you in the camp of those that are saying October or December? And should that be the case, by what degree or how deep do you, or how big do you expect the hike to be, 25 or 50?
So I think it should come in at around in October, because between now and October, like there's a lot of things going on. And remember, even if the core inflation, let's say, comes in at, let's say, around 2%, assuming the war ends, the service inflation, which the Fed looks at very closely, it's really high. It's the funflation side, so we expect maybe the Fed to hike probably by 25 basis points in October. And if that happens, probably also again in December, but it will really depend. Probably what might cap the path of hiking, probably it's the labor market. We saw earlier this month, the data come out a bit softer with 57,000. And the labor market is quite in a tough place. So I think that one might push the Fed to maintain a wait-and-see approach. But remember, it's not only the Fed. We expect the South African Reserve Bank to hike this month, probably by 25 basis points, and then pause a bit. And also probably in Europe, the ECB, the Bank of England, I also expect them to hike. Probably not this month, but in the near term.
Yeah. Much of the conversation that we continue to have with many market watchers as it relates to monetary policy is a direct impact coming from the events and developments in the Middle East. But I wonder at what point do we accept that this is probably the new normal, where the US and Iran agree on a ceasefire but continue trading oil airstrikes, and then we see it in the oil prices that continue to jump up and down. And at what point does this become the way in which we live, where perhaps we're living in a world of structurally higher inflation and higher oil prices as well?
Yeah, so let me mention something about oil prices. I think we are entering in a very dangerous place in the energy markets, because the war is right now going on, and we've seen oil prices go up by around 20% from the lowest point in June. Now, remember, inventories are continuing to go down in the US and in other countries. And also, China has been away from the market for a while. It did not buy oil for like 3 months. And so we could see China start coming into the markets and buying. And now, and in addition to that, let's not forget about what is happening with Ukraine. It's been bombing a lot of oil targets in Russia. So basically, I think the new normal for the oil markets is higher for longer.
Sure.
And also, when you think critically about the US and Iran situation, like what happens next? Like, can Trump really end the war right now? If he ends the war, like, it will be a loss for the US. And Iran believes that it is in a very good place to continue escalating. So I saw Trump says that next week will be the bridges and infrastructure period. And what happens when it does that? We'll see Iran also has a lot of targets. In terms of the escalation ladder, I think Iran is really well positioned to escalate further and cause a lot of damage. And finally, let's not forget what is happening in Saudi Arabia. They are having a conflict with Yemen, the Houthis. And also now, that now might bring the Red Sea to the table, to the oil markets. So I think oil markets might be primed to go up a bit in the next few months, unless we have a real deal. But now...
Yeah. I mean, when does it end, and what's coming after this? Where to from here? I suppose that is the golden question, but unfortunately, I don't think anyone at this stage has the answer. It's up to Trump to decide. You mentioned that the oil prices could remain structurally higher, or we could be living in a world of higher oil price regime. Sorry. Looking at the oil prices right now, trading at a 1-month high of $86 a barrel. Does it get worse from here, and what is the worst case scenario in your view?
So I think in the worst case scenario, there are a few. The worst case scenario number one is if the war in Iran escalates. As I've mentioned, Iran has a lot of targets that it has not hit yet. It can hit oil projects in UAE, in Qatar, in other places. That's number one. Also, the Houthis can join the war, and now we will see the Red Sea be closed. And remember, the Red Sea, we are seeing like over 10 million barrels cross there every day. Now, if that is cut off, and if China now starts buying, right? If China starts buying oil, and when the Ukraine and the Russia war escalates, I think the worst case scenario, we could see oil at 150 and above, if in the worst case scenario.
Okay. While I still have you for the little time that I do, let's talk quickly about the U.S. earnings season that kicked off yesterday. I mean, it's off to a solid start, right? The big four banks reporting, JP Morgan and Chase, Bank of America, Citigroup, and Goldman Sachs, all topping analyst expectations. But just from your perspective, what are the key metrics that you'll be looking out for in this earnings season?
So yesterday we saw something really unique happen in the earnings season. We saw that big banks, as expected, they released really good numbers, and it was really as expected because trading revenue was really up because of this volatility, and also the mergers. Like in the first half, the M&A was up by around 41%, and the deals, we saw SpaceX go public. So basically, looking forward, I think so. Companies that did well were not really rewarded as much. But those that, especially IBM, that came out a bit lower than expected, it was really punished. So I think this is what we are going to see during this earnings season, where big beats and raises are not really well appreciated, but misses or even near misses will see a lot of punishments. But broadly, we expect the earnings growth in the second quarter to grow by around 30%. In the first quarter, it was, I think, at around 26%. So the earnings growth are there. So that's why there is talk about an earnings recession, an earnings bubble, where we have so high expectations on companies, and that's why you are seeing when companies release also some really good earnings, their stocks come down. We saw that with Micron. We saw that with Samsung also the other week. So it will be really a volatile period for the markets in the near future during this earnings season.
Yeah, of course. I mean, and we also saw it with is it SpaceX? We saw it with SK Hynix as well. On the day of the debut, they spike up, but a couple of days after they do come down.
So let me mention something about that.
Okay.
I think that's something that has been going on for so long, where a company goes public, pops, and then crashes. We saw that with Meta in 2012. Last year, we saw that with Circle, Figma, and we also saw that with other companies. Every company that went up public last year had an initial pop and then crashed after that.
Okay, let's talk about Richemont as well, which came out with its Q1 earnings. So certainly setting the tone there for luxury stocks in this reporting period after surprising investors with numbers, with sales growth that came in at almost double the consensus forecast. What were your initial impressions of those numbers, and what does it signal about the outlook of the high-end sector?
So the earnings were really good. I think 7.6 billion. They were really good. And as we look at how the stock is performing, I think it's now at an all-time high in South Africa and also in Switzerland. But and also the numbers came out a day after we saw other results from watches of Switzerland yesterday in the UK, and they were also really good. And they are being driven mostly with the US, and also the Asian markets. I think the reason for this is that the stock market is doing really well, and now people like the wealthy have a lot of cash on hand, and so, but something interesting is happening also in the market. We see while Richemont is at an all-time high, other companies like LVMH, Kering, Burberry are all significantly lower than where they were last year. So I think it's time to be selective. I think I'll be a bit critical about Kering because of the Gucci. I don't think they have the right designer, but it's about to be. No, I think it's about to be. It's market investors should be a bit selective when selecting the companies in the luxury sector, and also remember that recently we saw Hermes was doing like really well, but right now it's around, I think, 30% below where it was last year. So I think markets should be a bit selective when selecting these names.
Yeah.
Because the valuations are also quite high as well.
Yeah. I think it's also quite reflective of the state of the consumer. Consumers, especially across all income bands, have become quite selective given the constraints in the economy. Just lastly, DRD Gold. I'm sure you would have seen their update on their Vision 2028. Just your quick thoughts on that strategy.
Yeah, I saw the report, and I know you are interviewing the CEO shortly after this, and we saw that the stock it has been really, it has not done well, and the strategy, I think the markets are still digesting the way it came out, but basically for gold companies, I think it will take, it will need for gold prices to start reversing, which will take time because right now gold is competing with very high yields. You know, the 2-year yield in the US, it's around 4 point something. So when yields are high and when investors are focusing on the AI, I think that's why gold and also Bitcoin are really struggling this year. But probably once the hype surrounding these things start going down, I think now we can start seeing gold go up, and that should
Yeah.
that should boost DRD and other gold miners as well.
I mean, we are speaking to the CEO after this,
Yeah.
and I see the share price is down more than 3% following the release of that report. But as you've mentioned, probably it is the case that investors are still digesting and trying to wrap their head around this new strategy. But Crispus, let's leave it there for now. Thank you so much for making the time to chat to us this afternoon. That was Crispus Nyaga, research analyst over at Empire FX.